so like I was living in Russia and we weren't winning. So they one of the remedies to make us play better is they gave us these like gallons of goat's blood and they told us to go home and take baths with them. Like we were supposed to bathe in goat's blood. And so obviously me and the other Americans were like, we're not doing that. So we went home, and one of the things about Russia, it's like lawless. There's like no police ever. So we got home, it's the dead of winter, and we're like, what are we gonna do with this goat's blood? And we're like, hey, let's create a crime scene. So we went back to our apartment and we literally like splashed the goat's blood in one spot, like where someone like got stabbed. And then we had it like run down the wall. And then we had one of the guys in the ground and we dragged him across the ground. And like, so it left it in the snow and we put like blood all along over to where the cars were, like the parking lot. And then we had just end. So it looked like someone got stabbed, got dragged over to the parking lot and then like thrown in a car or something.
And the police believed that you made that up, that didn't really occur?
No. So we did it strategically. So we were like overlooking the parking lot from our apartments, and we sat there like for the next 2 days. Every time we get home from practice, we'd look and it'd be like not a single person said a word. Like people walk by it constantly. Not a single person said a word. No cops showed up. Nothing. It was just a crime scene, like blatant crime scene, and nothing happened.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 9 of Drunk Real Estate. I am Kyle Wilson, also known as Ashley Wilson's husband, and I'm once again joined by my stylish best friends here, starting with Mr. Jay Scott with his beautiful drink he's got sitting next to there. I don't even know what to call that.
So I was on vacation last week with my wife. We were traveling for our 15th wedding anniversary. We're an all-inclusive, and I made the mistake. Of all the drinks I had last week, I made the mistake of ordering one really, really, in her words, girly drinks. And we got into a little tiff over it. And so I agreed that tonight I would let her make me any drink that she wanted, and I would drink it on the show. And I believe this is a White Russian with some chocolate syrup in the cup, and then some extra for when I finish this in the nice pink sparkly container. So I am drinking a White Russian this evening with chocolate syrup.
It looks like you ran out of shirts too. You had to wear your son's.
What's wrong with my shirt?
The Hurley board short shirt.
Okay, I'm going to be honest. They were selling these 3 for $10 at Costco.
Well, there you go. Fair enough. Mauricio, how's it going, man? What have you been up to? You look like you're not at home.
Not only that, but I'm in a good mood today. Like I was a little grumpy, a little grouchy last time, but not today. Today, I'm in a good mood. But yeah, I'm not home. I'm at a hotel. That's when you're not home. You're at a hotel. No, I'm here in beautiful, balmy Scottsdale, Arizona. It's like 113 degrees. It's freaking hot as can be. But I'm at the hotel. Options are limited. Mayomi Pinot Noir 2021. I think they just literally.
You get that delivered room service, or you actually go out of the hotel to get it?
I ordered food last night. The bill was like obscene for like a brisket sandwich. I was like, really? So anyway, good to be with you guys.
Yeah, you'll probably hit up the minibar too. AJ, how's it going, buddy? You're still sitting there with no dinosaur head behind you, which I'm a little bit disappointed.
I know. I really need to switch it up and get Ernie in the picture. But yeah, till then, I'm sitting here sipping on my Red Bull, sugar-free, of course, because I'm very health conscious.
I'm not going to lie here. This is actually really, really good. You guys got to get into this.
God. Oh my God.
Well, I'm sticking to my bourbon again today. I'm doing a repeat, so I don't have to tout it, but bourbon for another day. Well, we haven't done an economic.
Hold on. AJ, how late do you drink that Red Bull? Like how late can you go? When's your last Red Bull typically in a night?
I mean, it depends, but if they're around, I drink them if they're sitting there. So, yeah.
I had 2 of them at the resort last week. One night when we were sitting at the bar, I didn't sleep till the next night. Like literally kept me up pretty much the entire night till the next night.
Yeah, but when you drink so much that like AJ does, like it doesn't even phase him. He feels a little bit of a jolt for 5 minutes, and then it's just he drinks it for the taste.
Exactly.
All right, well, let's get to some economic updates because we haven't done one of those in a while, and we've had a lot of updates this week, starting with the most forecasted rate hike in history, I think. They had going into the meeting, they had a 98% or 99.2% chance of a rate hike, and they followed through with that. But then we had an encouraging PCE print, and we had a surprisingly high quarterly GDP report. But out of the blue, then all of a sudden, Fitch goes and downgrades the United States credit rating. I didn't see that one coming. So, AJ, why don't you kind of give us some clarity on everything that's been going on in the last week?
Yeah, we are in a very strange economic cycle, one that the United States hasn't ever been in. And we've had, you've had several people that have been talking about this for a little while, like Ray Dalio and others, where what occurred during COVID and this massive, essentially capital movement and transfer around, where the economy it looks like it's resilient, but the government is in shambles, both in debt and leadership. And that's what the downgrade really came from, was the lack of trust in the United States' ability to make sound fiscal short-term decisions, but also just the simple lack of solid leadership that has just completely eroded away over the last decade in the United States. And I was listening to Jamie Dimon. He was talking about this a few days ago. He was here in Boise, and he said that all the major problems we're currently seeing is a direct result to lack of leadership. And in history, we're going to look back at this time as this just gaping hole that we've had of strong leaders within the government. And a lot of what we're looking at between these decisions and the downgrades are predicated on that. So you have runaway monetary policy, a handful of things that they've really drilled down on. Even when you're talking about, first of all, the government deficits and debt, the inability to tackle short-term challenges relating to rising Social Security and Medicare costs due to aging populations and not doing anything with that. General just government deficits, which are out of control.
And Fitch called out basically how we were on the verge of not raising the debt ceiling too, as kind of one of the contributing factors.
And I think that's probably one of the big ones, because if you think about it, I mean, it's been, and again, I'm going to blame both sides of the aisle here. It goes all the way back to when Obama was president, when Trump was president, the Democrats did it. Now that Biden's president, the Republicans are doing it, where basically the party not in power seems willing to sacrifice our economy, or at least threaten to sacrifice our economy for political gain. And will they actually do that at some point? I hope not, but it seems like every cycle we get a little bit closer, the threats get a little bit more serious. And
but like, does that really deserve a down? Like, do we really think, even let's say hypothetically, we get to a situation where they don't pass a debt ceiling hike? Do we really think that the U.S. is going to default on their debt? Like, that'll be the last straw to drop. We'll see the parks close, and we'll see some government workers get furloughed, and we'll see those things all happen. But do we really think that we're going to default on our debt? Like,
no, and that's why they're still AA plus credit rated. It's just not AAA.
Yeah, but you got to look at the cost associated. They don't need to actually default for it to have massive implication or problems. I mean, look at what's going on with everything from T-bills to our overall, the CDS rises. The cost of insurance against default and everything is up 90+%. So there's this lack of confidence, not so much even in the long term, but it's these short-term decision makings. And Jay hit it on the head. You're talking about we have a political system right now that they win by destroying. So what we do is we are going to literally threaten the overall safety net, right? We're going to go after political rivals. We're going to do all of these things. Meanwhile, we have all these problems and they're ignoring it, right? So the current administration, the last administration, they're not focused on actual real problems. Instead, they are 100% wrapped up in their political opponents. And what that's causing is a derailing of the system to be able to, as Fitch put it, tackle short-term and medium-term issues that the government's supposed to be on top of. So the government needs to be fixing a lot of these things. They need to be putting up legislation to tackle everything from our problems with our long-term liabilities. And there's just nothing. They're not moving on it. They're not doing anything with it. And that's really what the downgrade is about, because what they're saying is we're not seeing a change or an outlook to which we're going to do these. And so I think it's more of a warning and a way to say, in order to be a AAA rated country, we have to have confidence that you can actually run this country. And when you look at the economy today, it's this is what we're talking about. The economy has flipped, where you have the government has these huge deficits. It has these huge issues that's going on. And we have inflation, you have uncontrolled spending, but then the private sector is actually relatively strong. And so it's being resistant towards these things, but the government's doing everything they can to, muck it up. And yet it's still going. Where normally what we have is the government is the lender of last resort. They're financially stable. The private sector gets out of control, right? Because that's what the private sector does. It goes till it can't. And then all of a sudden the government is the adult in the room. And that relationship seems to be massively strained. And it shows in so many of these economic data numbers that we're looking at. Confidence in the U.S. economy is now down to almost 2016 and before levels where they thought that we were going into another massive recession. If you look alone at the risk implications, monthly job openings, right? The tightening in the labor markets, and this is all kind of coming to head with an erosion of the capital. So we're getting to a point now where overall cash in bank accounts, savings rates, we've been living off this. So we've still been living off this transfer from the government taking on debt, giving it to the private sector, right? And now that is starting to burn up, but the government hasn't really gotten it back on track. So saving rates, which were sky high for years, we are now below prior to the pandemic. We're under 5%. I mean, we've dropped off to a low that we saw in 2008. So that capital is just burned off. And household borrowing is now, it's ticked up a little, but it's now cratering because people can't borrow. So we are below a historical norm even there. So there's all of these, this tightening that's working, getting rid of cash. It's doing its job, right? So it's actually doing its job. And we're right there. I think everybody's saying we're just kind of right on the verge, which Fitch agrees. Fitch says in the fourth quarter and the first quarter, we will be in what is probably a mild and light recession, because they believe obviously we can get into easing again and kick it up, which I tend to agree with this. And this point.
Here's the crazy thing. This happened last time back in 2011. It was right after another debt ceiling debacle with under Obama, and looked like they might not come to an agreement. There was a shutdown for a couple of weeks. Finally, they came to an agreement, and S&P did the downgrade. When S&P did the downgrade, it was front page news. The markets dropped. Treasury spiked. I mean, everybody was freaking out. I thought it was really interesting this time around. I'm not going to say nobody mentioned it, nobody thought about it, it wasn't discussed. But for the most part, I mean, the response was pretty muted. The stock market had like a 10-day streak of updates.
Because what does it mean? Like, what does it mean? Like, it's always, when you talk about ratings, it's always compared to what, right? So if you are giving somebody a rating or a triple B rating or all these different ratings, it's all compared to what? And they're still all comparing to the US government. That is still the gold standard. So why, like, what is the difference between a triple A and a double A plus? That's still the gold standard of what everyone's going to compare against. We really don't think there's any, like, even if we do think there's a little bit more risk of the US defaulting on their debt, which there's still basically zero. Like, they're basically just saying, like, oh, we're gonna downgrade you just because we don't like what you're doing. But at the end of the day, you're still the gold standard. And in my opinion, the gold standard should always be AAA. It doesn't matter. It's always compared to what.
Yeah, but my point is that the dichotomy between what happened in 2011 or the response in 2011 and the response now is huge. So one of two things is true. Either we severely overreacted in 2011. And it didn't seem like anybody did. Nobody said, no, this isn't a big deal. We're taking this way too seriously. Nobody said that. Or we've gotten so desensitized to everything going on in the economy, everything that's going on politically, that something that 10 years ago, 12 years ago was the huge deal worldwide.
But didn't they overreact?
Yeah, but wait on a second. You can't compare.
How did they not overreact? Nothing happened. Like the U.S. government didn't default on anything. Nothing happened. So they overreacted.
People started to say we need to demand more from politicians. That's not overreacting. Now, what we're saying is we can actually downgrade our actual ratings, which does have cost. It costs you in the bond market. It costs you in the insurance market. It costs you on swaps, right? There is actually a trajectory where this has
how is this punishing the people in power? How are politicians getting punished by this? Like, the only people who are getting punished are the people in the actual markets. We're punishing ourselves.
So we should then demand more from politicians because we hire them. They're not in charge. We are. And that's the problem. Nobody feels that way. Nobody's doing anything. And like Jay said, now, because nobody cares, we're too busy on, are we attacking Trump, or is Trump attacking Biden, or and that's why I think even to Fitch's things is a really true statement. The medium-term problems, the United States said, just like Jay said, nobody cares.
I don't know. And maybe I'm wearing my tinfoil hat a little bit on this, but the timing's just a little, like, convenient considering the U.S. just came out saying they're, like, upping their auction, their treasuries that they're putting out there by 10-15%. So the treasuries were already going to go up because the supply was going up so much. And at the exact same time, right after they announced that, all of a sudden Fitch decides right then they're going to downgrade the US. Like, I don't know. I think it was kind of just a dick move, to be honest.
I look at this as kind of like we have this in the military or national security. We have this DEFCON system 1 through 5, and I'm not sure which one's the worst. But let's pretend like DEFCON 1 is the worst and 5 is the best. Just because you go from DEFCON 5 to DEFCON 4 doesn't mean we're about to be in a nuclear war. But it's a warning that things are going in the wrong direction.
How many minutes to midnight are we right now?
And so that's another thing. Just because you're a month into the year, you're in February, doesn't mean you're really close to annihilating the world. But it is an indication that things are more risky today than they were a year ago or 5 years ago or 20 years ago. And I agree with that. I mean, think about it. We have another budget bill that needs to get passed in September. Congress is gone for most of the next couple months. They're back for a couple weeks, and then they need to pass another budget. And do you think that budget contention is going to be better than the whole debt ceiling debacle that we had a couple months ago? It's not. It's going to be worse. As we get closer towards the next election, everything's going to be a bigger fight. And
they're in the middle of indicting Trump. I mean, it's going to be nasty.
And so I think this is just, again, this isn't dropping to a AA plus, isn't anybody saying that they really think the U.S. is going to default, but it is an indication that they believe that things are worse than they have been and they're getting worse. And if things continue in this pattern, that in 2 years or 5 years or 15 years, we could reasonably be in a situation where we could potentially default on our debt.
So the question, do we think that Powell and the Fed are taking this into consideration? Any of these things, or you think they're just holding strong, okay, jobs and inflation, that's all we care about?
Mauricio, you haven't said anything.
I don't know. Do I need to be here, or just it's good 20 minutes here? I'm trying to get a word edgeways here.
Jump in.
Look, first of all, I think it's kind of funny that where does Fitch get their credibility these days? Because this is the same, and not only Fitch, but the S&P, all these credit rating agencies don't know what the hell they're doing, right? These are the same agencies that were giving AAA ratings to these mortgage-backed securities in 08, 09. It's the same rating agencies that are giving Silicon Valley Bank, tip-top ratings, the day before it collapses. Like, they don't know what the hell they're doing. I agree with Kyle. It's a little bit of a political thing. I don't know if anybody really believes what they're doing. Anybody cares. I always just think it's a joke, especially after 2008 and how terribly wrong all these agencies are. I'm not shocked that they're still around, but clearly the reason they're still around is because there's a lot of back and forth. Even the way these guys are compensated, right? I mean, it's all so much conflict of interest. So I don't really put that much weight on these guys. I don't know if that's what's happening now and why people aren't making a big deal about it. Maybe they just don't take them as seriously. I am happy, though, that it is putting a spotlight on a lot of these issues that we're having, which is good, right? I mean, we have a deficit problem, we have a debt problem, we have a debt to GDP problem, we have all these problems. I know, Kyle, you don't think it's a big problem that Japan's at 200, 300% GDP. Who says we can't go that high? It's an issue. AJ referenced the insurance now on that you need to pay now, the credit default swaps to pay for this kind of insurance. Those all go up. So it does have repercussions. And I'm happy that it's putting a light on the fact that we aren't all rainbows and unicorns, that we do have some major problems. So that part I like, but the fact that Fitch itself went from AAA to AA plus, like, I certainly don't care what Fitch has to say. I don't think they're credible. And I'm hoping that I don't think that's the reason for it, but I would love for the market to just be like, dude, these guys are a bunch of clowns anyway. They don't know what they're doing. They've been wrong before. So I don't put that much weight below it. But I also wouldn't compare it to 2011, because in 2011, remember, we had just kind of come out of this great financial crisis of 08, 09. We were still basically at the bottom of the market. People were on pins and needles. So if something like that happens back then, everybody was really nervous. Today, it's a little bit different. We've been going through this, 15 years of economic expansion. Everybody thinks everything's great. So I think it's a difference of a comparison. But again, I don't think it's a big deal. We've seen a little bit of a spike we've seen quite a nice little spike on the Treasury. I don't know if it's related to that. I think something about nothing. We get back 6 months from now, you're going to look back at this time and it's going to be a non-issue.
Yeah, but it is interesting that was the one impact. Yeah, we saw some declines in the stock market, but I mean, all within what you expect these days, a couple 100 points. But where we saw a big hit to the economy or to the markets was that 10-year treasuries did spike. I mean, they were under 4% 2 days ago when the announcement was made, and now it's like 4.2%, which is pretty significant. It's the highest it's been in at least 9 months.
And mortgage rates spiked, not spiked, but went up again today as well.
And yeah, 10-year treasury is gonna impact mortgage rates, and so
and that's why the stock market goes down, right? Like if the treasuries go up, then you got to say, okay, if I'm going to put my money in, what's the safer bet? All of a sudden, the treasuries, they're yielding a lot higher. Maybe I'm going to pull my money from the market and put it in treasuries if they're that high.
Yeah, I think at the end of the day, this will blow over. It'll be forgotten about. I don't particularly agree that it's political. If it is, I can't figure out what side they're trying to benefit, because at the end of the day, this generates talking points for both sides. I mean, it happened under Biden, so it's real easy for the Republicans to say, "Hey, look, Biden's screwing the economy. We've downgraded the credit rating." The same time, Fitch said specifically part of the reason they did this was because of the January 6th stuff that happened. And so the Democrats can use that as a talking point against the Republicans. So I don't think it's a clear win for either side from a political standpoint. I'm not saying it's not political, but it's just not obvious to me if it is, what side they're trying to help.
Self-serving. That's what I think it is.
And I agree with that. It is self-serving. And I agree with Mauricio. But one thing that I think shows how much of a joke it is, that the fact that our ratings haven't deteriorated alone in the last 10 years, when the United States fiscal position is so much worse off than we were just 4 years ago. That alone should have put us right in a position that everybody is demanding change. And I think that speaks to the greater issue that I think we have today. First of all, nobody believes in the government, either side. And the economy right now, I feel like so many people think it's rigged. It's connected, right? We're running all these things. And there's a we have an absolute confidence crisis. And I think that the United States in general, we got to get over a lot of these issues and a lot of issues that aren't important to what's actually going on. It's become a political circus that we overlook everything and we don't care about things that are actually really important, like long-term problems, tackling issues. And we just don't seem to be taking care of problems like we used to, right? And I agree. That started with Obama when we started to see him trying to bypass and go straight to making decisions. And then Trump picked it up and then Biden. And it's a big change. And with that, in both of those 3 terms now, none of those problems have turned around. They've only gotten worse. And I think it's right that it should be downgraded, but I also think that it's right. It doesn't mean Fitch knows what they're doing.
So should we just have an AI run the country then for us?
100%.
I think we should definitely pick better leaders.
Well, since Microsoft released the ChatGPT to public, everyone's been trying to tack on AI to their business. So why not the U.S. government?
That's a really good segue there, Kyle.
Thanks. Because most people are talking about how AI is going to just make things better. But I know, Jay, you've expressed some concern about how there's potential downsides as well. So why don't you talk to us about some AI risks that we might be seeing upcoming, and specifically maybe how this relates to real estate?
Okay, I guess we're moving on, huh?
Yeah, we are.
Okay.
We spent long enough shifting the economics into politics. So
Fair enough. Yeah. So, yeah, I've been thinking about this a lot recently, and certainly AI has been tremendously valuable on a lot of fronts. I can write my articles a little bit easier, and I can proofread my stuff a whole lot easier with ChatGPT. And I know a lot of people in this industry are using it for things like marketing and lead generation and content creation. And no doubt, AI is hugely beneficial on a micro level and a short-term level. But at the same time, I think us as investors, and specifically as real estate investors, there's also a couple risks. And I think one of the biggest, and I'll highlight 2 here, but let's start with the one that I think is the biggest, is that AI is going to lead to tremendous productivity gains. And when I say that, I mean the things that were previously taking an employee a couple hours to do, AI can potentially do in a couple seconds. Things that were taking 10 employees a week to do might be able to be done in a few minutes. Stuff that was impossible to do before. Just kind of parsing through huge amounts of data and making sense of huge amounts of data. Stuff that just couldn't be accomplished, or maybe could only be accomplished through spending a lot of money on supercomputers and processing power, is going to be generated and done a whole lot easier. And so what that's going to lead to, most likely, is that we're going to see a huge productivity spike. And at the same time, we're going to see an impact on employment. We're going to see an impact on the number of people that companies need to hire and need to keep employed to accomplish all this stuff that AI might be able to do a lot cheaper and a lot more easily. Now, obviously, there's a risk there with unemployment. Unemployment's always bad, but I actually see a bigger risk to us as investors, and that's specifically that with all of these productivity gains, typically when you see productivity increase massively, you see prices go down because employers don't have to pay as much in labor. Things get built and designed and created much more cheaply. And so they can pass that savings on to consumers. And so this ultimately could lead to disinflation, lower inflation, or even deflation, where literally prices are going down because it's so much cheaper to be creating products and services thanks to AI. Well, what happens when we see deflation? What happens when prices go down? It doesn't just impact the stuff we buy on the shelves. As investors, especially as real estate investors, it's going to impact things like rent. And so one of the big concerns I have, and I'm curious what you guys think of this, is if AI massively increases productivity gains and leads to disinflation or deflation, how does that not impact us as real estate investors by making housing cheaper, making rent cheaper, and basically hitting our NOI?
But it should, just as you explained, it should make our operations cheaper too, right? So if we want to talk about our marketing, our payroll, all of these different line items that we have on our balance sheet, yes, we might see a hit on our top line, but our bottom line, technically should get offset a little bit by this increase in productivity on our own operations.
Sorry, I was going to say it offsets everything else. It offsets everything else too, because if you do have deflation, that means my purchasing power is increasing. So yeah, maybe I'm getting lower rents, but that money that I get from that rent allows me to purchase a lot more of other goods and services that I want, because all the other goods and services have gone down as well. So it's tit for tat on that.
Yeah. So that's my number one, is that I think a lot of people are thinking about AI from a productivity standpoint as being a huge benefit. And it is, obviously. For business owner, it's a huge benefit. But I think for us as investors, deflation or tremendous gains in productivity leading to lower prices can ultimately hurt us, especially as real estate investors. Number two, and I've been thinking a lot about this, the competitive advantage that we have. Let's talk about AJ and Kyle and myself as syndicators. One of the big competitive advantages that we have over others is simply that we know our markets really well. We can go in, Kyle and I invest in Houston, AJ, you invest in a bunch of different cities, but presumably you know those cities that you invest in really, really well. And when we go against big institutional investors, the BlackRocks, the Blackstones, and these other big institutional investors, one of the big competitive advantages we have over them is that they can't be in every market. They can't be in every asset class. They can't be at every price point, because they literally have to hire tens of thousands of people to get to learn those markets. And so we have an advantage because we can specialize in a market, and we can really take advantage of that specialized knowledge of a particular market, a particular asset class, a particular price point. But one of the things I think AI is going to be a great equalizer of is the ability to parse data. And so a company like Blackstone is going to be able to go in and build AI models and AI tools that can basically go in and say, we don't have somebody in Newark, New Jersey, or Omaha, Nebraska, looking at Class C industrial storage or whatever. And yet with these tools, they're basically going to be able to learn everything they need to know about that asset class, that price point, and that location without having labor dedicated to it. And so what we're going to see is these large organizations that can come in and they can analyze any deal in any market equally as well as we can. And then they're going to be able to take deals from us because their cost of capital is going to be lower than ours. And so I think what I see happening over the next several years is that a lot of these big players are going to be able to use their ability to get really cheap capital because they can find investors at 4%. BlackRock, Blackstone can find investors at 4, 5, 6%. We can't do that. And so when they can start analyzing deals in our markets as well as we can and be making investing decisions as well as we can and start offering on every deal that we're offering on, but with a lower cost of capital, they're going to start taking deals from us. And I have a feeling that a lot of mom and pop investors, commercial investors, are going to go away over the next couple of years. And a lot of these larger and institutional investors are going to start just increasing their market share.
We're already building out a tool that does pretty much precisely that. It analyzes income markets. It looks at daily fluctuation in everything from rents to property types to all that. And it puts out maps that will map out everything from spreads to all sorts of stuff. So I think, Aladdin is probably that on a bigger scale. But I think that this AI tool, I actually think that it'll put it in the hands of people that like more mid-size, that we can use it in areas where they may not be going as much. At least that's what I hope.
Yeah, I was actually going to argue against Jay on that, to your point, that I think AI will give access to some of the tools that only the big shops have right now, because they do have the scalability. They can hire, to Jay's point, tens of thousands of people to analyze things, and they're just big enough scale that they can incorporate that. While AI is going to give the tools to the smaller shops that are similar to these bigger shops and allow them to compete more with the guys at the top.
Aladdin is how BlackRock got to where it is.
And I was going to go against Jay just because I like going against Jay, and that's a good sport to do. And just whatever he says, I like to say the opposite. But I don't necessarily. I'm not going to go there. Actually, I actually was thinking about it from a complementary, different angle. And I'm actually interested in your guys' take on this, because a couple of episodes ago, we did an episode on the demographic shift, right? And we talked about how not only around the world, but even in the United States, our population trend it's already starting to come down, right? Because the baby boomers are retiring, and we've got, the group that are entering the workforce, they're a much smaller population. Our fertility rate is below break even. So we're starting to get a little bit tightness in the labor market, and we're expecting that to continue over the next 10, 15, 20 years. With our immigration policy, we're not really supporting that lack of employment or labor that we need from the immigration side. The question I have is this a potential solution for us? This increased productivity in the AI space, is that going to fill the gap that a lot of people are projecting on the labor side due to demographics? You guys thought about that angle?
Won't it just shift though? So like when you look at the internet, like when the internet came out, everyone was saying, oh my God, this is going to kill so many jobs. There's going to be so much unemployment. But then it just shifted and it kind of created all these new jobs through the same thing. I'm not smart enough to predict every job that an AI shift is going to create, but it's going to be a job just being able to train AIs is all of a sudden going to be like one of the most sought after jobs out there. It's going to just create these new jobs that we'll lose some on this side, but we'll gain them on the other.
Well, that's what happened in the Industrial Revolution. That's what happened with farming equipment. That's what has happened with every industry that has employed like 80% of the world. Technology came in and revolutionized it in such an outstanding way that it basically eradicated those industries from ever being major employers ever again. And all those people went to create and do more, and then we had more. So I'm on 100%. I think the short-term problems may be significant, but long-term, I think it just allows us to do more, because you have the internet, then there's AI, then there will be the next thing, right?
I feel like this is a little different. And the reason for that is that if you look at every other, I don't want to call it industrial revolution or technology revolution that we've seen over the past couple hundred years, typically what we're seeing is the jobs that go away are the jobs at the bottom. They get replaced by technology, and basically everybody kind of moves up the ladder. And I think that's a good thing. I think for the first time, the risk is that the jobs that are going to go away aren't necessarily the jobs at the bottom, but potentially the knowledge workers, the jobs at the top, the high paid workers. And so I see this as being a little bit different than those shifts. I'm not saying.
But want to create jobs at the top too? Like when you want to talk about like working with AI, that's a pretty high skilled job that's going to be required in order to navigate that.
Yeah, we'll have these things called prompt engineers, and these are the people that figure out the questions to ask and the prompts to give to the AIs to get them to spit out the results that we want. But the question is,
or to build them, not just prompting. I mean, people have got to build out. I mean, AJ, you just talked about a tool that you're building out. We're building out AI tools too. I don't know the first thing about building an AI tool. We've got to hire somebody. There's somebody that's actually doing that work and putting that program together, that tool together to facilitate what we want to do.
Yeah, I just at the end of the day, I feel like this is a little bit different, and maybe I know I'm crazy to say this time is different. We don't like to hear this time is different, and I don't like to say this time is different. But this time feels a little bit different, and it feels to me like we're gonna lose more jobs than we're gonna gain from this particular technology shift. And again, I don't think productivity gains are a bad thing. I think it's from an economic standpoint, it could be huge, but it could cause definite shifts in employment demographics. It could cause definite shifts in inflation and currency. And I don't know. I'm not smart enough to figure out where things are going, but it just feels like we're going to have some massive revolutions here.
Well, I hope you're right, because huge productivity gains are kind of one of the only ways, to AJ's point, that we can get out of this huge deficit that we've been creating. So,
and two, we have a failing population across the world. So honestly, the idea that we can have replacement for employment, that is so astronomically needed, because forward looking in the next 30 years, we have the opposite problem. We do not have workers for jobs. So, maybe and hopefully AI can literally be the savior of that employment problem, where we're sitting here going, our modern world as we know is going through ginormous transitional issues without having a working labor force to support it. And so if we could have some of this technology that can help us actually move into a period where we could shrink in population without having catastrophic effects due to the support system, right? And to keep that machine running, that'd be a great thing. But I think a lot of the problems that I see with AI aren't so much on jobs, but they're other things, right? I think we're going to run into a lot of communication problems. We are going to run into a lot of problems of human nature. I mean, you already see just weird things on like AI girlfriends now. That's already a thing. AI like popped up, and now AI girlfriends is like a thing. And like you got guys that
There's always going to be weird people with weird spouses, though. That's it doesn't take AI for that.
So just out of curiosity, just so I can do some research on this, do you have any websites I can check out?
The AI does not force you to drink girly drinks either. So that's one of the positives.
It's for science.
So, I mean, I think there's going to be other issues with it that'll be more than that, but more social problems, knowing what's real and things like that, who you're really talking to.
But we'll adapt. Like at the end of the day, everyone adapts eventually. It's just going to be, as you pointed out before, it's just growing pains, right? We're going to go through a transitional period, and then we'll figure it out. Fair?
Yeah. I mean, we'll figure it out, but I think this could lead to some big shifts, and I'm gonna go on record right now and say that we're gonna look back in 10 years, and we're gonna see AI as something that's hurt our industry as mom and pop or mid-size investors.
All right, I'll take the other side. I'll say that it's going to help propel mid-size investors and allow them better tools to compete with the big guys.
Okay. So anybody listening to this, put your comments below. Tell us who's right, who's wrong.
I think that, guys, AI, I think we're all probably vastly underestimating what it'll do. I think it's so powerful, and the implications are so much of what we don't know yet, that it will, to Jay's point, I think it's going to revolutionize. I mean, it's like the people that, who's the famous New York Times economist said, we're going to look back at the internet like the printer. The world as we know it today doesn't function without the internet. Literally, if the internet goes away, our world is over. And AI will be the same thing in 10 years, yet we just don't understand how that looks yet.
I agree with that. And I think it'll be even the next level up on the internet. But, the internet increased productivity 100-fold. I mean, I run a law firm. Look at the law firms pre-internet, the amount of staff they had, the amount of, records departments they needed. I mean, you couldn't run a law firm on a laptop. Like I literally could run a smaller version of my firm on a laptop by myself. Now I've got a team and we do a little bit more. Same thing with AI. I mean, it's gonna increase productivity, but does anybody argue that, the internet destroyed, XYZ? It's just, it increased everybody's productivity and people adapted.
Fair. All right, why don't we move on here to another big thing in our industry news is Crowdstreet. So people who don't know Crowdstreet, they gained quite a bit of popularity over the years because they've given a place for accredited investors to kind of search out private placement investment options. Previously, you kind of had to know somebody who knew somebody in order to know where to put your money. Now you could just go on the internet and you can do a quick search and you can get access to a bunch of different private placement options if you're an accredited investor. The problem with it is, though, the big sites like Crowdstreet, it doesn't mean that they're any safer than just going directly to a normal private placement. So, Mauricio, you're the securities attorney here. Why don't you walk us through kind of the problems that Crowdstreet's having right now and how that works with private placements?
Yeah, I mean, Crowdstreet's in a little bit of trouble just because one of the companies that they're working with, they're actually helping raise capital for, allegedly is committing some fraud and ended up actually taking investor money that allegedly was meant and allocated for closing on the property, just like any syndication. It turns out they allegedly never closed on the property, and that money's gone, right? So they were two specific properties that they raised, I think about $63 million or so. And one was a mixed use, I think, in Chicago. One was an office in Florida. everybody wired their money into these syndicators, and turns out they never used the money for what it was supposed to be, right? So at least if everything that's out there, which is all allegations, I don't know if anything is true, you're dealing with some fraud, but CrowdStreet is kind of caught in the middle there. And they've been taking a lot of slack because they sounded like there was no safeguards, there was no escrow accounts, so they really didn't know what was going on. But to be fair to crowdfunding, I wanted to point something out. There's not all of these sites have the same business model, right? So CrowdStreet was basically a market maker. They had a website that basically matched buyers and sellers, right? Theoretically, they're doing some due diligence on the sponsors, but they're not handling customer funds. They're not a broker dealer. They're not an investment advisor. They're simply, creating a marketplace.
Like a job posting site. Like someone posted a job.
It's almost like an exchange. It's like NASDAQ. You got a deal, Jay. You guys have a deal. You want to access some more people. You put it on their site. They've got a bunch of investors, and they just they help facilitate that. There's other groups like Realty Mogul and Fundrise that are actually broker dealers. So some of these firms are actually broker dealers. So they can literally take your money, refer you to the other sponsors, and take a commission because they're broker dealers. Other sites are sort of investment advisory firms. So they actually create these kind of fund to funds, meaning like, hey, here are all the investments. Hey, here's AJ Investments. Here's an investment from Jay and Kyle. And if you want to invest through that, well, I'm going to create my fund to funds, invest in my AJ fund, and then I will invest in that deal or invest in my, Kyle and Jay fund, and I will invest in your fund. So everybody's got a different business model. And to be fair to CrowdStreet, they literally had just started the process, or at least had been starting the process for a while, but just got through the process of becoming a market maker. Again, just kind of a website that matches buyers and sellers. To today, they're actually a broker dealer. So they've obviously, based on this issue, they've accelerated that process. So now they are able to handle client funds because they are a broker dealer. They can get compensated, transaction-based compensation. Because remember, these exchanges, they're getting compensated for just creating the market, right? So you pay these exchanges or these marketplaces a fee because they put this thing together and matching buyers and sellers. You're not taking transaction-based. There's no referral fees. There's no success fees. It should really just be, hey, I created this marketplace. I'm matching you guys. I'm kind of out of it. You guys make the transaction together. And that's what happened with CrowdStreet, is that the people actually wired money directly to these syndicators, which was Nightingale. And they, like I said, it was $63 million that they wired over. And there was a lot of slack to CrowdStreet that there was no escrow account. But the reality is, again, CrowdStreet can't take money from escrow companies because they're not allowed to handle client funds. They're not a broker dealer. And so they essentially said, here's the account to go wire it. And they wired it directly to Nightingale. And to be fair, it's not uncommon for syndicators not to have escrow accounts, right? You typically wire money into a syndicator. They have a segregated account in the business, but you don't usually escrow funds unless, it's a contingent raise, which very few people do. So again, at the end of the day, you've got a fraudulent situation here, which it sounds like we're seeing more and more of this in the multifamily space or in commercial real estate space over the last year. But basically, you're talking if everything's true, we're talking fraud, right? We're talking about some people wiring their money into the syndicator's account with the expectation that they're going to close. And if they don't close, what happens? Well, usually you get that money back, right? It gets wired back to you. In this case, the money apparently got transferred to other accounts, some of them from some of the CEOs and other people allegedly from CrowdStreet. And so from Nightingale, from the syndicators. And nobody can get any answers. Nobody can find out where the money is. So now CrowdStreet has essentially put Nightingale, those syndicator entities, into bankruptcy, which allows them to access more documents and basically find the money, follow the money to find out where this is. But it's a tricky situation. Another CEO of CrowdStreet was resigned or was let go. I mean, it's definitely cost somebody their job. But again, when you're a matchmaker, that's what you do. You just put that stuff up. But you've got a brand, and you're receiving compensation. And the idea, at least the promise, is that you did a little bit of due diligence on the sponsors. And again, these sponsors aren't random people. They've been doing lots of deals on these, and they were very successful. But again, everybody's got caught up in what's going on, which we've talked about in many episodes, which is just, a lot of syndicators are having issues because of the interest rates going up and the cap rates and the same issues you and I have in our syndication world. These large institutional syndicators are having, and I think CrowdStreet kind of got swept in on this. It's not going to be pretty for them. They're gonna be on the hook for something, but I don't really think it really is a blame to look at CrowdStreet given how their business model worked. It's definitely on Nightingale, and similar to other deals, they can't find these guys, which tells
So
me
are,
that
are they going to be on the hook though? Like I guess so. There's two sides of this, right? Like legally, it seems like CrowdStreet really didn't do anything wrong. It was just the optics of it and the expectation that CrowdStreet is this kind of governing body of everything that's on their site. There's the expectation that they did do some level of due diligence, even though they're not expected to. So, the two questions are: is
look, if you look at their website, I mean, it's all about looking at their terms and conditions. If you, I mean, even if you look at the website and you look at the, now, actually, if you look at their website, I didn't look at the website beforehand. So if you look at the website now, they tell you, hey, we're a licensed broker dealer and we've got the licenses and we're going to do certain things differently. I don't know what the website looked like in 2022 when this was all going down, but I think the only part that potentially they could have issues is I did notice that part of the syndication documents that Nightingale put out, they failed to disclose that they'd actually lost some money and had to give some of these properties back to the bank. And so a lot of people were like, wait a minute, if I'd known that, I wouldn't have invested. And so CrowdStreet took the lead to try and get some of that money back even before the deal closed. But again, if you look at the fine print, it's like the Dow Jones, like you're buying a stock, and if the stock commits fraud or whatever, they're just there to match buyers and sellers. Yes, there's an expectation of due diligence, but it's really difficult, if not impossible, to if somebody's committing fraud, it's really hard, right?
So, I mean, I can't speak to the legal issues, and it sounds like CrowdStreet probably isn't facing much from a legal standpoint. But the issue that I think they would face, if I were, and again, the four of us are all pretty sophisticated when it comes to investing, and I'm guessing a lot of CrowdStreet investors are sophisticated. But no doubt there are plenty that aren't sophisticated, and we have up for anybody that's looking on YouTube right here. It's a page off the CrowdStreet website for anybody that's just listening. Basically, what it says is, and I'll quote from this page, our capital markets team is on the ground in every region of the U.S. looking for well-respected sponsors in their deals. They bring these real estate investment opportunities to our investment team, which puts both the sponsor and their deal through a review process to determine if they're a good fit for our marketplace. And of every 100 deals, approximately 5 make it to the marketplace for investors to compare and review. Then below, they talk about what they do to actually review. They go through a background check and a track review, et cetera, et cetera. And so to some degree, they're definitely holding themselves out to be completing some due diligence. And again, I'm not saying from a legal perspective that they're on the hook to catch every bad actor that's out there. They're most certainly not. Nobody can do that. But as somebody that might not be a sophisticated investor, and we can argue over if you have the accredited status that you should be, but the reality is, by reading what they have on their website, it's not hard to interpret that they're doing some due diligence there and they should be catching some low-hanging fruit. The question is, was this low-hanging fruit? Was this something that reasonably could have been anticipated? Was this negligence on the part of CrowdStreet? Or was this just a bad actor that did a good job of screwing investors and it wouldn't have been easy to catch up front?
Yeah, we obviously don't have those answers.
So AJ, would you ever put our deal on a place like CrowdStreet, or is that not something that you would consider?
I don't ever want to say I wouldn't consider it. I do know some operators though that did. And some of the operators that did, I believe, did for specific reasons. And I think that it attracts a lot of those reasons. Meaning, I feel like they could attract certain crowds. There was a lot of stuff that was put into it. These were very astronomically high fee charging type things. And they went there because I don't think that they could get capital with those kind of terms and things outside. So that's my only real experience with those. I don't think it makes sense to be charged fees on top of fees. So you got to pay the syndicator, you got to pay CrowdStreet, you got to pay I think it doesn't actually make it even more transparent. In fact, it's almost the opposite. I had a harder time understanding and getting through things. So as of right now, that is not a method that I would utilize, but my experience is very little with them. And so I don't want to be too opinionated on it and state anything because I don't think there's anything wrong with it. I think it's a great business model, first of all. for them. But no, as of right now, I don't know enough to venture on.
Yeah, and remember, most of these, and again, CrowdStreet's moving in that direction. Most of these essentially are fund to funds, right? They're creating their own. They call them REITs actually, because they're kind of a specific. But basically, it's a vehicle where the investors actually put the money into, like I said, with Realty Mogul or Fundraise, they put them into their special purpose vehicles. And so one of the things you're getting compensated, all those fees are to go vet the sponsor, to go vet the deal. I mean, that's what you're getting paid, that fee. That's why they're investment advisors. They're getting paid a fee to go do that work that you don't have time to go do. You're a passive investor. You're working your job. You don't have time to go fly down and meet with a sponsor team. You don't have time to go walk all the units. That's why you hire some of these investment advisors or broker dealers. It sounds to me, again, I haven't really done too much work with CrowdStreet, so I haven't seen their website from pre this issue in 2022. So I don't know what they were saying back then. I know right now they're a broker dealer, and they're going to start doing things differently now. But back in 2022, they were a marketplace. But to your point, Jay, what they were advertising is, hey, we're doing the due diligence on them, and then the question becomes, would a reasonable, prudent exchange would have found something that should have brought up red flags? And I haven't seen anything, but I'm not saying there isn't.
Well, even in 2022, because I subscribe to CrowdStreet. We've never done any deals to them, and I've never invested anything. But I recommend anybody to actually log on and create an account. And if you're an accredited investor, they'll just give you an account, and you can kind of lurk around, because it's good to kind of see what people are offering, right? What kind of returns people are offering, what do people expect, and which ones are getting funded quickly, which ones aren't. But CrowdStreet did last year. It might have even been the beginning of last year. They created their own fund of their own offerings. So you could invest in the CrowdStreet fund, and the CrowdStreet fund would pool together a bunch of the offerings that are on their site. So when to Mauricio's point, there is an expectation there that if they're creating a fund and they're adding other operators and other deals into that fund, that they're going to be vetting them, and you have some reasonable expectation that they've done due diligence.
Yeah, I agree. I mean, that's part of the. I mean, I harp this all the time. Like, if you're somebody who's thinking about putting together a fund of funds, that's one of the main things you're getting compensated for, is to do all that legwork that your investors don't have time for, and especially if you're marketing and advertising that's something you absolutely should be doing.
Moral of the story is just because it's online and it's a big company, don't expect anything different than just a normal private placement. If you were coming to Jay and I to invest in our deal, or if you're coming to AJ to invest in his deal, do your own due diligence. Look at the operators on your own, and don't expect anyone else to do it.
And I think, Kyle, I just to say what you just kind of mentioned, I think that was one of my more hesitance with it, which, once again, I'm not saying anything about any of these companies or anything. It was almost though the separation or the gamification, it felt a little more like, oh, just click and buy. So it was like you could make decisions much faster.
Right. The whole Robinhood thing, right? With stocks, like you could log on and buy a stock in a few minutes.
Exactly.
Yeah. Fair enough. All right. We ready to move on to a top 10 tonight?
Let's do it.
Top 10. I know Mauricio is going to have some fault in it. So, but we talked about the AI there. So I'm listing the top 10 AI movies. So over the years, Hollywood obviously has had their own opinions on how AI is going to wreck our world in particular. So I'm going to list the top 10 AI movies. I'm going to go 10 through 5 pretty quickly. And then I'm going to have you guys list your top ones to see if they jive with my top ones. So number 10, I'd started off with one for the kids, WALL-E. Everyone's seen WALL-E. That's an AI about kind of the end of the world there. Number 9, I'm going out there a little bit. The movie Moon, Sam Rockwell. Great movie. He's stuck on the moon with just an AI. He starts to believe he kind of starts to go crazy. He believes that the AI is lying to him. Highly recommend. Number 8, Megan. I don't know if you guys have seen that recently. It just came out last year. Creepy movie, but it was very good. Number 7, iRobot. Literally a movie about AI taking over the world. Number 6, we discussed this a little bit earlier, about AI girlfriends. The movie Her. Joaquin Phoenix falls in love with an AI in his phone. So that's maybe that's a little bit of signs to come. And so now we're into the top 5. Any guesses? What do you guys think of one of the top 5 AI movies?
Let me just start by saying that I have never heard of any of those 5 movies. Now, granted, since I got married and had 2 kids, I have not seen too many movies. But are these like the top 5 in the United States, or are these like in Portugal and Belize?
No, these are my personal top 10. These are my personal top 10. I tried to find a definitive list, and it's very subjective. So I made my own personal top 10. And you're right.
I've never heard of any of these movies.
These last 5 have been in the last decade or so. And so you're a little bit older, Mauricio, so you wouldn't have.
Is Barbie an AI movie? I have no clue, dude. When it comes to movies, man, I'm out.
Barbenheimer.
Barbie an AI movie?
Barbenheimer. Well, there are some older ones, a couple older ones on the list next. So Mauricio, you should be able to guess them.
I know the best one.
What's that?
It better be the best one.
Odyssey 521 or whatever?
Space Odyssey 2001. Yes, that is number 2 on my list.
Yes.
Number 1 better be the Matrix.
Matrix, I didn't have as number 1. I had that as number 3.
So I was going to say Matrix would be number 2 for me. Definitely Terminator.
Terminator, I have as number 1. So Terminator, it was such a classic movie. And 2001 Space Odyssey, it's arguably number 1 just because it kind of created the genre about like the whole AI thing. So that's why I had it so high on the list. So I had Terminator series number 1, Space Odyssey number 2, just that one, not its sequel. The Matrix number 3, number 4.
Hold on. Can I guess another one?
I could see you Googling.
You're looking at the screen, Jay. You're like looking at your screen. Like
he's looking up at her top 10 list.
You're like asking your AI, "Hey,
I swear I'm not looking. No, I wasn't. I was looking at something. I wasn't looking at that. Blade Runner.
Blade Runner number 4, and then number 5 is a more recent one.
Is it? I love this movie, and now I can't remember. Machina.
Yes, Ex Machina. Yep, number 5.
What about Terminator 2? What about Terminator 2 and Terminator 3 and Terminator 4?
I had series. You couldn't just. I once again, Maurice, so just finding fault. If you look on my notes, I literally said Terminator series. So. But
speaking of, Netflix has a great documentary about Arnold Schwarzenegger. If you haven't seen it, worth watching.
Watch Pumping Iron though first; it's better.
Oh, by far.
Pumping Iron is one of the best documentaries of all time. Okay, since we're talking about movies, let's go into a little bit of a game here that is also surrounding movies. If you have James Bond, Jason Bourne, and John Wick all pitted against each other, who would win?
John Wick.
You're picking John Wick.
John Wick has the firepower. He's got like Benelli M2s and freaking some serious gunpowder. So I'm going to go with Wick, even though I've never seen one of the Wick movies. But
he does have the bulletproof suit.
He's got the bulletproof suits.
If I had a puppy that needed protected, I'm going John Wick.
His dog died though. That's literally the movie starts with his dog dying.
I know, but I don't put that on him. Fair
enough. I'm going the opposite. I'm going Jason Bourne. Jason Bourne literally planned everything out to a T. His plans were excellent, and he was great in a fight. I think he would have planned the whole thing out. John Wick kind of just shows up and hopes everything will work out, and he fights his way out of it. But I think against Jason Bourne with his plan, I don't think he'd pull it off.
My issue with John Wick is, especially, I just saw the fourth one on the plane a couple weeks ago. What world do we live in where supply and demand for assassins is that huge?
It's a comic book movie, Jay. Calm down.
It's a lot of assassins.
You also can't block a bullet by just holding up your suit jacket. That's not how it works.
I'm more concerned about the economic implications than the tech.
I was no physics major, but if you just hold up your suit jacket and a bullet's flying at you, it's not just going to stop it dead in its tracks.
I think Jason Bourne is like 5'9", by the way. I don't think he's that tall.
I don't think that really matters with, the other question is, does James Bond have the entire MI6 behind him when he's doing all this? Because that might change things, because he had quite the team.
And which one, right? It matters. It matters which James Bond. I can't just...
Let's go Daniel Craig.
It doesn't matter.
Okay.
Daniel Craig, he has the whole team behind him versus John Wick. He has a couple friends, but him and Bourne were basically on their own. So you got to take that into consideration. But all right, we had three votes for Wick and just me on Jason Bourne. Fair enough. Let's get into the plugs. Jay, you got anything this week that you want to talk about?
Let's see. we're working on, hopefully in the near future, Kyle and me having a deal to do with AJ Osborne. AJ knows nothing about this, but I figure if I put it out there, I'm going to kind of force him to start thinking about it.
Let's do it.
We've been trying to get AJ to work with us for a while, or us to work with him. So there you go. I'm gonna pitch anybody out there that's listening that wants AJ and Kyle and me to do a deal together. Put it in the comments.
I don't know. Do we want to do it with AJ? AJ was just talking about how all self-storage rents are just, we're seeing tanking self-storage rents. Is now the time to invest?
That's why you want to do it with me.
Yeah,
that
that's fair. Maybe we'll talk about that next week.
I object to that joint venture because then that's just one ppm for us, and I'd rather you guys do separate deals.
And you want to charge for two?
One for you. Who says you're doing the PPM?
Well, maybe, well, Mauricio, maybe we'll do it through a fund, so you'll create the PPM for our fund, and then you'll create the PPM for the deal for AJ, and then you can hit us twice.
You should invest in Premier Street. Premier Street has some interesting.
It's just a marketplace, though. It's not a broker dealer. Mauricio, what do you got to plug?
I'm going to plug. We just had Jay on the Real Estate Syndicator Live episode 64, I believe, that just dropped yesterday. So if you guys haven't checked that out, we do a whole deep dive on economics and where we are today. So if you haven't seen that, check it out on the YouTube channel, Mauricio Raould.
Jay, you want to give away a book if someone listens to both that and this? Post a comment on both of them?
Yes. Post a comment on how's somebody prove that they listened to both?
Yeah, drop a comment at the end. If somebody's here at an hour plus, man, give them props.
That's true. Drop a comment in both Mauricio's video on Real Estate Syndicator Live from last night and on this video, and I'm giving away a book.
We don't know which one. Just look behind Jay's head, and it's going to be one of those.
The last person that won a book, I let him pick.
Oh, wow.
Jay has a new book, How AI Will Revolutionize the Real Estate Industry.
He picked the newest one, Real Estate by the Numbers. Sent it out a couple weeks ago.
Oh, fair enough. AJ, what do you got for us?
So, we got our last property under contract for our Fund 2, which is our opportunistic fund, speaking of the rates dropping and everything. So we've been picking up properties at under replacement cost, brand new. We've got, I know, we're so excited, off-market deals. We're getting seller financing. So we're now down. We're doing the actual launch and the final push, and we're wrapping up Fund 2.
Nice.
Sure sounds like you're taking advantage of these poor operators that just bought poorly. And so, you're just a...
I am.
You are. And AJ, by the way, AJ, I'm looking at getting a new storage thing. They want to charge me $600 for a storage unit. That sounds outrageous. That's like rent.
$600 a month?
Yeah. $600 a month. Dude, you got to move to California.
For what size though? 5x5 or?
Dude, it's like a 100 by 100 or something. It's a pretty big unit, but still $600, dude. Come on, what's going on over here?
It's called a warehouse.
California, you're
it's like
you're competing against people's garages.
15. It's like a 50. Anyway, Kyle,
someone can live in that.
Kyle, who are you plugging tonight?
Who do you think I'm plugging? I'm going to plug my wife, Ashley, again. Badash Investor. Follow her on Instagram. She posted a meme today that was pretty funny. I thought and
YouTube.
And so I should go check that out. She's great for a bunch of really funny memes. So if you want a little bit of the lighthearted side of real estate, you can follow her just for that reason. All right, gentlemen, my drink is gone here. I'm going to hit the head. When are we doing? Next Tuesday? So I will see you
Tuesday.
next Tuesday.
See ya.
See you guys.